The markets are a little bit over the place, right? They're rallying, you see indices high in the US, and yet they're trying to figure out what comes next from President Trump. Would you take a pause when it comes to equities at the moment, or will they continue rallying?
I think they will take a pause, in particular in the US. And the reason is we are close to pricing a Goldilocks scenario. Basically, Trump will deliver the goodies, tax cuts and more spending. You have low rates for longer.
Okay.
It doesn't make sense.
But will he? I mean, will he deliver, or because so much of it is already priced in?
No, I think eventually he needs to deliver. So far, there's only words. But the market has already priced in, I would say, almost a blue sky scenario. Meaning you have margins all-time high, multiple on a CAPE adjusted close to all-time high, and you have rates all-time low. So it's very hard, to see what's next. And as a result, I think, for example, on our perspective, what we've been doing is buying protection on the S&P. Today, you can buy put spread, assuming the markets fall between 5 and 10% over the next 3 months, and get paid almost 8 to 10 times. It's unheard of. You're at a time with all-time low volatility, all-time high record days of up markets. Basically, you're pricing a very, very positive scenario. Any disappointment on either time or the Fed hiking, as they should, in our view, I think will lead to a market drop.
I look here, Davide, at that key phrase you just said, it's unheard of. And I think a lot of people on global Wall Street agree with you. We're in a territory we've never seen before. Are we in the territory of a so-called bull market, or looking at equities, bonds, currencies, commodities, are we in some territory that doesn't signal a further bull market?
I think, the issue here is some asset classes, let's take high yields, are pricing basically no risk. You're close to all-time tight on high yield. At the same time, if you look at the inflation data and employment data, we think the Fed is behind the curve. On their own numbers, they say they need to hike 7 times over the next 2 years. So that means probably another 1.75% increase. And when you look at the bond market, they are not signaling it. They're saying, no, they're faking it, and they won't hike as many times. And then the reality, I think, this time the central bank will have to go.
The critical question for you, and we'll do this later, folks, with Ed Hyman then, is do we see or will we see the GDP growth to justify that Fed scenario? The conundrum is, if you look on the Bloomberg, essentially it's just under 2% GDP growth. That's not good enough to get us to the scenario you speak of.
Well, but if you add the GDP, you add inflation, you add employment, you are in a scenario where you actually need a hiking rate. And you'll probably get that from the ECB, or at least the tapering of ECB at some point in time in 2018. And as a result, I think globally you're set for an environment where you're pricing all-time high margins, all-time high multiples, and ultra low rates, and you add the Trump effect, unless Elon Musk gets us to Mars pretty fast and we find someone else that can buy assets, then I think we're due for a pause.